Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Monday. It is December 6th. It's really funny. I was talking on the phone with a friend yesterday, and he said, let's do something middle of December. And I was thinking, wow, that's a long time away. And then I realized it's next week. I'm still eating turkey from Thanksgiving. I mean, I'm still in November. My mind is completely forgetting the fact that the year is almost over. It really is surreal. I guess it's to do with age. I don't know what it is, but time just flies. Anyhow, the market's going to open up in about 2 hours and 1 minute to be specific with you. And obviously, this is a recording pre-session. As you can see here, the Dow, the blue chips are doing pretty good. The NASDAQ is down. And by the way, I warned you that the tech was going to take a bath, that it's really overbought. That's why I've been avoiding tech stocks for a while. I'm usually early to the party, real early, but I usually get it right. And as I told you, we're going to see a major sell-off in the tech, and we're going to see market capitalization move from the NASDAQ, the tech and the chip and the consumer discretionary stocks, more into the consumer staples, into the Dow, into the blue chip dividend stocks. Matter of fact, I wanted to show you something interesting. This is kind of interesting here. If we go to stock fetchers and we go to my filters right now, and if you look at the 11 major sectors, you will actually see tech and consumer discretionary still leading. But notice where consumer staples is right now. Now, about a month ago, I told you that when consumer staples was down here, it was going to start going up when it was right next to communication services. Well, consumer staples are already here. For example, let's go back a month. Here's consumer staples. 1, 2, 3, right? Let's go to today. 1, 2, 3, 4, 5, 6, 7. Went up. And I think consumer staples are going to go higher, which means investors are going to be putting their money from tech and consumer discretionary more into the consumer staples, the higher dividend. This is speculative. This is defensive. So this is why I believe consumer staples will continue going higher. And that is something I've been talking about for quite some time. Just to give you an idea of my theory a few weeks back was that chip stocks, I kind of need to review this so you guys have a good understanding of what's what. Oops, let me go to SMH. So my theory was that chip stocks, the divergence here, we're going to cool off. We're going to see more downside. They're going to come to the 50-day moving average because we were overbought. And the same thing was going to happen to the QQQ, which happens to be at the 50-day moving average right now. These are critical levels. So one of two things is going to happen. I think we're going to have a shakeout on the QQQ, and we're going to come back up because we are near critical levels, and we're near overbought, oversold territory. We may go down a little bit more on the QQQs because we're near the 50-day, but if you look at the Dow, we're already at the 200-day moving average. And it looks like the Dow is ready to come a bit higher, and it did go oversold. So I think we may see a little more volatility, a little more drama on the tech, as you could see based on where we're at this morning and based on what I've been thinking about last few weeks. Because I think investors are taking their money gradually out of the high flyers and putting them more into the conservative stocks. And that's sort of well, actually, that's exactly what we're seeing right now. A few things to point out to you that are very, very important, and to confirm that I'm not seeing a major meltdown from these levels. I think we're near shakeout levels. So for once, look at the put-to-call ratio. We're really, really strong. We are really weak right now. The market is bottoming out. This is a sign of bottoming out. Matter of fact, this is the the highest level that we've seen since middle of last year. All right, middle of last year. So we're talking about this is 114. This is really, really high. So last time, 520. This is when we were still coming off of COVID. That's very, very, very bullish right here. We went from being really, really bearish to really, really bullish. And let me show you the VIX. VIX looks like it's topping out. It looks like it's going to be coming down from here. Huffing, puffing, but unless this COVID extends itself, and I'm not seeing it right now. I'm seeing people confirming that the big O variant is not as deadly as the other variants. It looks like we'll be coming down on volatility. So I'm expecting volatility to start coming down. I'm expecting the Dow to start moving higher from these levels. I think the Dow has bottomed out, and I think we're going to go higher from these levels. And again, we may be seeing a little more mishigas, a little more drama from the blue chips that need to cool off, from the tech that needs to cool off right here, and the chip stocks. And they're both kind of in the same category. So as you can see here, I'm very particular about these, about what I'm seeing right here. And again, with the NASDAQ 100, we could go down further because we're not oversold yet. We could go down, but I think we're going to shake out somewhere in the twilight zone, kind of like this, and come back up. And that may put a little more pressure on the Dow. But I mean, NASDAQ 100 down 71, Dow up 230. Let's see what the SMH is doing, what the SOX is doing overnight, if it's down or up. Okay, so it's down 0.16. That's what the closing was. Well, I guess we'll see at the open. There's no overnight quote, but let's look at SMH if it's set to open lower. Yep. Oh yeah. Yeah, 1% lower. There we go. So yeah, it's happening. It's happening. So as you can see, QQQ, let's see how much down it is pre-opening. 47. Yeah, chips are definitely, unequivocally taking a slide today. This is why I was holding out on the stock, Micron. I was short the stock, and we got stopped out, but I think it's going to come down. I think ultimately, I was dead right on the direction. Just got stopped out because of the volatility. But let's not reminisce on all of this. Let's talk about what we've got going on this week. This week, the big dates. Let me tell you what the big dates are going to be. It's going to be CPI. That's going to be the big one. Jobless claims, they've been really, really solid. Consumer sentiment is going to be very, very big. International trades in goods and services is going to be really big. And productivity and costs is going to be telling. So there's not that much data this week. The market is going to have a chance to trade on its own. Looking at the bond market, we're already down 1. I think the bond market has peaked out. I think that's about as high as it's going to go. And also, just FYI, it's diverging. Do you remember that diverging that we talked about? Lower highs, not by much. As a matter of fact, let's see here. The high here is 68, and the high here is 60, but just by a little bit. But it's still diverging. This level couldn't sustain this level, but look at the price action. And exactly the same thing happened. Exactly the same thing happened on chips. Look at that. Boom, boom, and look at over here. See? Lower, higher, down. Same thing happened with tech. Higher, lower. Lower, lower. So I'm seeing the same type of trading action on the bonds. It's actually a lot of stuff going on right now. I got to say, look at that divergence. Whew. And not much there. And it looks like we're going to turn lower. So looking at each individual sectors, as I mentioned before, tech and consumer discretionary are still leading. But I'm expecting these two to start cooling off, and I'm expecting consumer staples to continue going higher. What's interesting is basic materials and industrial, they're not fragmented anymore. Consumer staples and utilities, they're not fragmented anymore. And technology and consumer discretionary are not fragmented anymore, which means the market is not as stretched out. And if you look at the, not the put to call ratio, but if you look at momentum levels look like they've bottomed out. So we could go a little lower, but unless there's a crash, which I don't think we're going to get, I think we're near the turning points. So in terms of what stocks to look at this week, what sectors to look at this week, I think technology and consumer discretionary are going to be weak. I think the energy is going to start getting its footing back. I think real estate is going to be choppy. I think basic materials and healthcare and utilities and consumer staples, especially consumer staples, I think they're on their way up right now. There's a lot of Dow and a lot of blue chip stocks and consumer staples. I think you're going to see some love out of consumer staples. I think you're going to see some love out of industrial. And I think you're going to see some love out of financial stocks, because I think rates are going to start coming up again and bonds will start coming down. Communication services, still kind of on the choppiness factor. Healthcare, choppy. Basic material, a little higher. But I think utilities and consumer staples are going to go up. And I think consumer discretionary and technology are going to continue putting pressure on the market. That's what you can expect this week. The biggest indicator I would pay attention to would be the put to call ratio, because it's bearish as hell right now. And I would also look at the bond market for sell-off. And lastly, I would look at the VIX. Where is my VIX? Oops. And there's my VIX, which is down already quite a bit. So VIX, I'm expecting to go lower. Blue chips, I'm expecting to stabilize. And chip stocks and tech stocks, I'm expecting to have their big shakeout. So be careful. Be careful of tech stocks right now. I would definitely look into more defensive stocks, especially with the Fed telling us that they're going to increase the pressure at which they cut off the bond purchases every month. Now, before I let you go, I've got to tell you something really important. Chuck Hughes, 10-time heavyweight champion trader, he wanted to prove the effectiveness of his triple threat blueprint with real traders. And let me tell you why it's called triple threat. Because it has 3 sub-strategies: bullish market, bearish market, and choppy market. Chuck has you covered in all 3 market cycles. So he set these traders, real traders, on the loose with a $50,000 simulated brokerage account. Not a piece of paper where you write down your trades. A real simulated brokerage account that tracks trades for professional traders when they're building a track record. So you enter a trade, it records your order. It's as official can get, and it's documented. And obviously we couldn't give $50,000 of real money to hundreds of thousands of traders. We're not Bill Gates just yet. So we set these traders with a $50,000 simulated brokerage account to see what type of returns they could achieve. And you should see how some of his best ideas performed in just 3 months. Click the link below. Check out the full experiment. I've never seen anything as cool as this. Some guys made over 300% with this. It was really something. You'll see all the numbers. You'll see the breakdown. You'll get all the details. And most importantly, we want you to get into this triple threat strategy because the markets are giving us 3 different threats: upside, downside, and choppiness, especially right now. Click the link below to see the secret behind all of this. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market. Be the first to be notified when we post our next video. And tomorrow, I'm going to give you the strongest sector, strongest stock, weakest sector, weakest stock. Do not miss out. All right? Don't miss out. I'll talk to you guys later. Send me some feedback. I want to know if I've been giving you the right pulse on the market. I've been telling you that the techs are going to be selling off and chips are going to be selling off for 3 weeks already. It's finally happening. And keep your eye on that put-to-call ratio. We're oversold right now. I'll see you guys later. Have a great day. Send me feedback. Support marketgeeks.com. Bye.